Bajaj Finserv 3% higher. M&M, again, M&M also had very strong numbers yesterday. CLSA today has upgraded the stock to a high conviction outperform. Their target price is 45.88. For Motilal, I think Nomura's target price on M&M is even higher at 4,875. And considering that the stock is closer to 3,300, that's a big upside from here on. Maruti reports numbers later today, ahead of that seeing buying. Strength seen in stocks which benefit from lower crude prices, Asian Paints, Interglobe Aviation, higher in trade. The banks which are lifting the Nifty include an SBI and Axis Bank. And HDFC Bank too is largely rebounding from levels near its 52-week low. The 52-week low on HDFC Bank is 726 and the stock is now about 3-4% above that level. So that level is providing some support. Hindalco is higher, Shriram Finance also up in trade. On the way down, the top 5 losers are the IT names. Coal India, ONGC also under pressure. Along with that, Aisha Motors.
Well, just keep an eye on the auto pack. You know, Mahindra numbers are good. Maruti's numbers will be due today. But I think, the stock of the morning from the auto pack is actually Hyundai. You know, I'm reading a sales note. I'm not sure I can quote it. That's why I'm not quoting it. But they believe that they see that the Hyundai stock has bottomed out and they see good upside in the near term. And that's why they're saying that Mahindra will be a portfolio stock, but they are betting on Hyundai actually outperforming. So we'll see how that goes. At least for starters, Hyundai is off the blocks in style. The casualty of the morning on the downside is Thermax. The stock had seen a good run and now the street is clearly disappointed with the numbers. Explains why the stock is getting slammed down. Astra Micro, just take a look at the way that stock has moved up because they've got a 2,200 crore order from HAL. That's not the point. The order book ahead of, prior to this particular order was around 2,200, 2,400 crores. So effectively with one single order, their order book has doubled. They've gone to more than 4,500 crores of order. And that's why, in fact, the street is bidding up that stock despite the big run that we've seen. On the downside, a couple of other notable casualties. You have Nucleus Software, stock is down. Revenue growth was down by 6.4%, margins at only 1.5%. So that one is lower. Thangamal Jewelry, the casualty of this week actually, the stock has lost 25% of its market capitalization. And Data Patterns is the other one that's taking it on the chin as we speak. TDPI, recall the stock had gone to 1,300 rupees. It corrected to around 900 rupees. And, in the last couple of days, it's making its way back. So that one as well is up 6.5%, as is the case with Black Box as well, bouncing back as we speak. So a green start, outperformance coming in from the broader markets, but plenty of big result reactions.
Yeah, no, absolutely. And, there will be more. It's been such a vibrant market with so much action and activity, which has dominated. I mean, single stock action has been just astounding. In some ways, in mid caps and small caps, to use the phrase, the chase is on, and has literally been a chase where there has been action. There's been just too much action. That's what we're seeing. Just two names, right? I mean, when we talk about this entire AI theme, etc., MTAR Tech should come up on your screen. So we've been highlighting on the way down that it had fallen from 9,000 to whatever, I think to about 5,000 rupee levels. Yesterday, finally, it was up 5%. It's another 5% this morning. So that is MTAR. So that's essentially, supplies to Bloom, which then supplies to all the hyperscalers in the US. So it's a closely linked name in that sense. And I think the other is NetWeb. NetWeb had fallen sharply. So they basically make supercomputers and, server racks, etc. So 5% higher on that one. So about 4,400 right now on NetWeb. So it still remains quite a bit lower from the highs. The recent listing of Indomim, not recent, just yesterday's listing of Indomim is another 4%. So, 40% higher listing on Indomim. We have the management with us right here. When the issue opened, it's up another 4% on Indomim at this point in time. So, yeah, I mean, there's a fair bit, all the other power and their entire electrification theme, right? Look at GE Vernova, you maybe look at Hitachi, look at CG Power, TD Power Systems is up 5%. So that entire pack is coming back along with names like NetWeb and MTAR, etc. This has essentially been the best performing parts of the market for a while coming through. So we'll keep an eye out on some of this stuff as we move forward. Pankaj Murarka is with us, CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Good to have you with us here. Thanks for joining in. I think you've been focused on, a lot of stuff. But you've liked banks for a while, Pankaj. lots of debate and discussion around whether it's now time for private banks over public banks. But, you just look at earnings as we wrap up this earnings season. I mean, I think PSU banks are still continuing to perform very, very well relative to where private banks are at. So I just wanted your thoughts there. And what is the best way to get exposure in this space now?
Morning, Prashant. See, the point as far as state-owned banks are concerned is the fact that these banks do 1% ROA and low double-digit kind of ROEs. So essentially, the business is not value accretive because they're hardly meeting your cost of capital. So while state-owned banks, you're right, have shown strong growth in terms of loan growth, but I don't see that being value accretive to shareholders over the medium term. And what we see in terms of the way they are pricing their business is obviously we see, meaning they've been, competing very aggressive in the market, and they've been lending at rates which does not make economic sense. So while in the short term they can deliver growth in loan growth and profit growth, but that's not value accretive. So I still believe that in favoring private sector banks, the larger banks have faced some constraints on growth. And some of the mid-cap banks, but have been delivering very strong growth. But my bias still remains for firmly for private sector banks. And I think the sector is pretty well poised in terms of valuations are reasonable, asset quality is pretty good, and I think growth trajectory is improving. So, and one of the few sectors which is trading at significant discount to the index in that sense. So I find a perfect combination of healthy growth and very reasonable valuations in the sector.
Unfortunately, it's not made money. Many of these large private sector banks over a 3-year, 4-year, 5-year period haven't yielded any shareholder return. But what about IT, Pankaj? I remember our last conversation. Was it a month back? Was it 2 months back? And you sort of gave that sense that market had become overly pessimistic on the IT stocks. And we've seen that play out. There's a complete U-turn in market sentiment now. Software stocks globally, services companies here in India have made a comeback. My question is that the rally that we've seen in July is led by the narrative fears receding. But it's not backed yet by fundamentals, earnings fundamentals. Growth is still in low to mid-single digits. I mean, how much can they re-rate further from here on when earnings are not backing them?
Absolutely, Rima. I think what has really happened is now the one fear or the overarching narrative which was playing out that AI will, decimate business models of these companies, or probably with vibe coding you don't need services companies, that has been decisively addressed. And which is, I've been saying for a while, that the market's fear are overblown. And on the contrary, AI is a tailwind for services companies because their TAM will expand significantly, and global clients, Fortune 2000, Fortune 5000 companies cannot, adopt and implement AI on their own. While it's a very foundational and transformative technology, it effectively means more business opportunities for IT service companies. So I think that piece of the fear or narrative is addressed, I think, now from what we've seen. And in the very fact that the foundational model companies themselves are setting up services companies is a validation of business model or the need for services companies' existence in place. So the second part of it is that there's been some degree of revenue compression in the existing businesses for these IT companies, which has been hurting them. And more importantly, I think these companies have been hurt by macro uncertainties globally, with supply chain disruption related to tariff-related disruption, which has been playing out on the markets for the last 12 months. And over the last 5 months now, this whole Iran and Iran-led global disruptions where global clients are holding back discretionary spends. I can say that in my experience of last 28 years that I've been seeing this sector, probably this is the longest duration of about almost we're in the 4th year where discretionary spends are held back by clients, which effectively means there's a lot of latent demand that exists or pent-up spends which our clients are holding back. And I don't think so they can hold it back for long. So you're right that the growth is very moderate. But I think also we need to see in the context that given the fear that's been playing out in the sector valuations today are where they were during global financial crisis in 2008. So I really believe that while I concede that the sector has not done well, and it's been at the receiving end, probably one of the worst performing sector in the last 12 months. But I also believe that for a value investor, probably this is one of the finest opportunities to be investing into these companies for investors who has a 3 to 5 year time horizon. And I certainly think growth will accelerate because clients cannot hold back spends. And if the adoption of AI has to happen, then IT services companies globally have a very meaningful role to play in it. So probably at this point of time, there's a high degree of pessimism, but I think things will change in next 2 to 4 quarters. But these kind of uncertainties and pessimistic views globally does create a window of opportunity for long-term investors. So I firmly remain, convinced about the growth outlook for these companies.
All right. Hi, Pankaj. It's a Friday. Tech, banks, let's keep them aside. Let's talk about the fun elements. I say that because I think you were bullish on a couple of names. Pizzas and whiskey. In the last 1 month or so, the whiskey play actually has popped up. I think United Spirits was the stock that you were looking at very, very closely. It went through a bit of a correction, but in the last 1 month, it's up, I think, 12-13% or thereabouts. So clearly, the street is getting the drinks together. What's the view on this stock, on the space as well? But on the flip side, people are not eating too many pizzas, it seems, because Jubilant FoodWorks is under some pressure. And I recall you being quite positive on both these two names. What's the current thesis?
Yeah, before I answer that, maybe let me just step back and give a broader overarching view on the market, I think, which is playing out. I think in the last 12 months, I see while, global economy or Indian economy is in a perfect Goldilocks state, I think quality has been beaten down and cash flows have been beaten down. Markets have been chasing growth irrespective of with a disregard for cash flows. And which leads me to a belief that I believe that's a great, there is significant rotation trade that's playing out in the market for the last 4 weeks. It's playing out globally as well, and we can see signs of that in India as well. So a lot of quality companies, cash flow generating companies have been at the receiving end and have not done well over the last 12, 18 months. But my experience of investing tells me that the value of a franchise or any business lies in cash flows. Meaning, I've heard narratives like, cash flow investing is dead and people just want to chase growth mindlessly, irrespective of whether overlooking whether companies are generating cash flows or not. I've been through multiple cycles where markets have disregarded cash flows, and those kind of stories do not end well. So coming back to these companies, when we talk about, Nigel, some of these consumer companies or discretionary consumption, I've been positive on discretionary consumption. These are companies and businesses which have a very robust business models and which generate significant cash flows at the end of the day. While they've been out of favor, but I certainly see that coming back, and these companies continue to execute well despite the headwinds they've had because of higher oil prices, some more elevated inflation or raw material prices, and supply chain disruptions across LPG, oil prices, and all of that. I think with all of that in the base and behind us, the good thing is the demand resilience in the economy is fairly strong. And I find, again, as I said, some of these companies available at valuations which are like multi-year, bottom cycle valuations, which effectively means, probably the potential returns from these companies over the next couple of years could be very significant. Also, let me tell you that, one of the best performing sectors, let's say in the last 12 or 18 months, has been industrials and defense. But bear in mind that we are in the 6th or 7th year of this cycle for these sectors, and valuations are at extreme and at margin in terms of whatever results these companies have come up with. There's been more disappointments in those sectors, and stocks are trading at 60, 70 multiples, and many of these companies are not even generating healthy cash flows. So I certainly see a rotation trade out of industrials, cap goods, and some of these best performing sectors of the last 12 months into some of the other sectors which are trading at significantly below their long-term averages.
What else do you like? I think autos is a theme that you've been betting on. And in autos, where will value be made from here on, Pankaj?
So, one thing is very clear, Rima, that the future of automobile is EVs. So clearly, we are looking at companies across OEMs and across ancillaries, which will have a meaningful play in EVs, because it's apparent now that on the two-wheeler side, we've already reached 10% penetration on EVs, and that's an inflection point. So we certainly see a very accelerated growth in EV ecosystem, in the two-wheeler ecosystem. And I think probably passenger vehicles also should get to, something like a double-digit EV penetration in the next 2 to 3 years, which effectively means the next decade in autos is all about EVs. So we own quite a few of, OEs, and we like the traditional OEs as well, including Maruti, which we bought a few months back, because I think after a long time, we are seeing that whole customer upgradation cycle coming in after a gap of almost 7 years. I'm seeing customer upgradation cycle where customers are upgrading from two-wheelers to cars. And when you get into entry-level cars, Maruti dominates the space. And likewise, we like company. We own a company called Excite Industries. They've set up the first lithium-ion battery plant in India. Probably should get operational probably towards the end of the year. So we like that whole EV theme or OEs and ancillaries which are transitioning their business to the EV ecosystem.
Okay, thank you very much for that. Pankaj, great chatting with you. Always a pleasure. All right, let's move on and talk about AWL Agribusiness. They reported a good set of Q1 numbers. Higher oil prices have driven growth. To discuss this, we have Srikanth Kanhere, MD and CEO of AWL Agri, here with us on the show. Thank you very much for joining in. Looking ahead, what would volume growth stand at? And what's the outlook on margins? Because we did see, edible oil prices go up in Q1. How much of that have you been able to pass on? So give us a sense of how the rest of the year is going to look like.
Okay, I think thank you for having me on your show. I think we have been able to deliver a better set of numbers in spite of too much of volatility that we have seen in the quarter. We have been able to give a underlying volume growth of 7% and a revenue growth of 15%. With a operating EBITDA of close to 700. I think it's one of the good set of numbers that we have been able to post in a couple of last quarters. As we go forward, I think now we are getting into more of a festive kind of season in India. We should able to post underlying volume growth of close to 8-9% that we have been saying. And of course, the EBITDA and margin growth, of course, EBITDA to the extent of 2,600, 2,700 crore for the full year. That is what we are looking at. Number one. Number two, on the prices, I think volatile quarter. There are a lot of price rise we have seen. I mean, we have been able to pass it on to the consumer in this quarter successfully, given the fact that we have quite a good brand equity in place.
Got that. And what about on revenues? You are guiding for an 18 to 20% revenue growth for this year? What's that predicated on?
Yeah. In fact, I think we don't give a revenue guidance per se, typically because our revenues are impacted due to inflationary pressure because the kind of brand equity we have been able to pass it on. So what the guidance that normally we give is the volume guidance, and that's the guidance which we are giving that we should be able to deliver 8-9% kind of volume growth this year.
All right, sir. But you're also, I'm reading a Nuvama note where you're talking about 18 to 20% revenue growth. That would be the broad number, right?
See, Q1 we have delivered 15%, and assuming the prices remain stable and we deliver a volume growth of 8-9%, I think it's 18% of revenue growth should be there.
All right, let's talk about market share then. Edible oil market share, what is it? Where is it headed? And have you gained some market share?
See, edible oil market share, we are hovering around 17-18% for quite some time, and being a leader, and we are the strong leader, by the way, because the number two is quite at a distance from us. Maintaining a leadership itself is a challenge, and while we do work to improve that our market share, I think 18 to 19 is something which we are targeting for this year.
Sir, good morning. Could you give us a sense of where inventory stands? Have inventory's gone up quite a bit?
Yeah, so the Q1 we saw some kind of tepid demand because of the April we had some supply chain disruption happening because of the Middle East crisis, and therefore no demand. And June again was not that great as far as the demand is concerned because the trade was anticipating bearish trend in the edible oil prices, and they were not ordering, and they were just in time kind of inventory maintaining. So primary was dried up, and that's also led to some kind of inventory accumulation at our end. But I think this all inventory should get utilized when we go into Q2. July is already going good for us. Probably August, September, we should be able to get rid of the excess inventory we have.
Got it. I mean, so this is just to give us a sense of how much is the inventory now compared to historical average levels?
No, see, normally we maintain an inventory of 30 to 35 days, given the fact that most of our raw material is imports. And in the import, you have a voyage period of anywhere between 35 to 40 days, and therefore you need to maintain that kind of inventory just to ensure that you are not out of stock at any point of time. But in this quarter, since the demand was not that great, edible oil grew only by 2%. We have some inventory in hand. So I think we are right now maintaining an inventory of 45 to 50 days. Q2, I think we should be able to get liquidation.
Quick commerce has also opened up as a key growth driver. Value is up 64%, volumes are up 56% on a year-on-year basis. So what percentage of your sales now happens through e-commerce and quick commerce, and how different is the profitability versus general trade distribution?
See, quick com, of course, it's different for both food and edible oil. In edible oil, we are selling close to 10% through quick com, or other, I would say, an entire alternate channel. In food, the percentage is quite high. In fact, we are selling close to 18-19% of our products in food category through quick com and e-com. And from a profitability perspective, I think it's of course better because you avoid all the intermediaries and you are supplying directly to these e-com platforms. But we are investing also on the other side. We are investing for visibility. We are investing for ensuring that we are available across all the pin codes. So the good amount of resource and time is getting invested. So from a profitability perspective, if you really ask me, more or less similar to general trade, because we are investing right now in these channels.
And you have a target of hitting 10,000 crore of top line by 2030 and an EBITDA of 400 crore. Is this going to be achieved with a volume growth of 8-9% that we're expecting this year, 18% in terms of top line? What's the glide path to get there?
So this question you are asking for food or for the overall scheme of the things?
I think for overall you have a guidance of 10,000 crore, right? On the top line?
No, last year we closed at 74,000 crore of revenue.
Right, this is about the food and FMCG.
Yeah, so the food is something which we are driving to achieve that 10,000 crore, which I think that should happen by FY28.
FY28. Okay, so you're advancing the guidance?
No, we are not advancing that guidance. I think we are staying on that guidance of 10,000 crore of food revenue by FY28.
Okay, thank you. Thank you very much for joining in. That's AWL Agri for you. Time for a break. On the other side, we'll connect with the management of Deepak Fertilizer to talk about the Q1 performance.
Welcome back. This is Corporate Trader and you're watching CNBC TV 18. Well, let's get to our next management then. Deepak Fertilizers, they reported a very strong set of numbers in the first quarter despite the significant volatility and supply chain disruptions that were caused by the Middle East crisis. Mr. Shailesh Mehta, the CMD of Deepak Fertilizers and Petrochemicals, joins us on the show. Hi, Mr. Mehta. Always good to speak to you, sir, and congratulations on a very, very strong quarter. Now, your EBITDA has come in at around 850 crores, which is phenomenal. Now, given the price environment, the volumes, the expansions that you're talking about as well, though we have some supply side risk, what can FY27's EBITDA look like? In the past, you've done a number at peak of close to around 2,000 crores. But with this sort of a start, should you end the year at close to around 3,000, 3,500 crores? Give us a broad target.
Yeah, aapke muh mein ghee shakkar, as they say.
But you're the one who's running the company, sir, so you'll have to give us the number.
I know. So this has indeed been the best ever quarter. And the top line grew by 22%. As what you are saying, the EBITDA also grew by 65%. But the best part of the story has been PAT double. So it has, crossed 101%. Also with that, our net debt to EBITDA ratio improved from 2.86 to 1.4 on. So from all sides, good story. Instead of speculating how the year will end, let me tell you the fundamentals. That at the core, what we are seeing is that over the last many years, we have been focusing on strengthening our complete value chain. And right from LNG gas, which, if you recall, we have signed a 15-year contract with the Norwegian giant, to our ammonia plant, which we set up some years back, to nitric acid, to somewhere the downstream chemicals and fertilizers, and then, of course, now move towards the specialities. So this whole value chain, now we are seeing that in this volatile environment, with the war and all that, we are seeing a very, very strong push and strong help in terms of resilience, in terms of managing the vagaries in the supply chain, and of course, the cost optimization. So that is something which is going to stay with us right through the year. And with that, we are hoping to ride through the year also fairly well.
Right, Mr. Mehta, that's a very helpful qualitative assessment. Good morning and congratulations. With this latest flare-up that we've seen once again, because everything comes off oil prices. Diesel, for example, things like, it's not relevant to you, but diesel cracks from $30 are back at $80, right? Is this causing a shock once again, for your inputs?
So indeed, for us, now LNG and ammonia are now within our fold, which are a major, major raw material. But for the fertilizer business, phosphoric acid or some of the finished fertilizers will have, continue to have some impact. And with that, the costs will go up, which is where we are looking at the government to quickly come up with the right kind of support in the subsidy schemes.
What exactly will be needed?
See, fundamentally, two aspects on the fertilizer side, chemical side, and which is, of course, 70% of our business. We are on a very, very strong wicket. But on the fertilizer side, which represents around 30% of our business, that is where supply dimensions in terms of phosphoric acid, and then the price dimensions, where, since the government does want to maintain a certain price level for the farmers, the subsidy element needs to be corrected, timely. That's the need.
What's the backlog now, Mr. Mehta? Not just for you, for you as well and for others.
So the subsidy flow has been good, but the correction in terms of, if this is now the new, let's say, raw material prices, whether it's ammonia or phosphoric acid or the others, getting it corrected into the subsidy has been a slow process.
Basically, you need an increase in the subsidy allocation.
Indeed.
And how much will be required? At an overall level? Because I'm sure representations have gone, right?
Yeah. So now, see, what is happening is that the raw material prices have been going through a very, very volatile swing. And that aspect of it is somewhere we are also requesting the government to keep a shorter gestation between looking at the prices and looking at the correction in the subsidy regime. Because these are, as you know today, that, these are highly volatile. So that is an aspect we are awaiting the government to, react on.
Sir, on chemicals and mining, you all signed a 15-year long-term LNG contract with Equinor in May. And with that, you get access to ammonia. So now you're no longer dependent on the spot prices and the wide fluctuations that we see. And that's clearly helped you with your margins this time. So if you could tell us, what were the cost savings enjoyed by you on account of this Equinor contract? In Q1, what will it be for the full year? And therefore, can margins sustain at 24% and plus?
So there are 2-3 elements, but you're right, the Equinor gas contract has certainly helped us on two counts. One is ensuring availability, which is a key thing. And as you know, a lot of the industry suffered during the earlier part of the war. And for us, that had been a great savior. The other is our own ammonia plant now, which is next door to where the rest of the complex is. So to that degree, not only saving the carbon footprint, but also huge saving in the freight costs. Those two have certainly helped. And somewhere from a cost dynamics, if one were to look at a full year, we could be looking at 300 crore plus in terms of cost saving because of the gas contract itself. On the rest of the things, because these are all linked to market prices, that we'll have to see how that pans out. But we've seen now that, all the demand drivers have been very strong. And to that degree, there has been also good absorption of any price increases. So from that viewpoint, all that has been positively reflected in the Q1 and should continue.
Okay, but 300 crore is the rough saving that you anticipate for the full year?
Just on the gas front.
Just on the gas front, got that. So you've got two mega expansion projects, the Gopalpur TAN and the Dahej nitric acid project. Are they on track to be commissioned in Q2? And particularly once these two come on board, what will be the ramp up and therefore the expected revenue and EBITDA contribution?
Indeed. So these are, I would say, two major expansions completely up our alley. These are expansions in spaces where we've been there since the last 45 years. So complete knowledge base of technology, market, everything. And with the addition at Gopalpur, our capacities will now increase by roughly around 3.7 lakh odd. And we will, in totality, cross 1 million tons. And that will squarely put us to among the world's top 3 in the technical ammonium nitrate for the mining sector. As far as the nitric acid goes, by the Dahej addition, another 3 lakh tons is emerging on the weak nitric acid and 1.5 lakh on the concentrated nitric acid. With that, we will totally add up and we will become 1.7 million tons and probably Asia's largest as far as the building block chemicals goes. From a financial perspective, I would feel in a full year, let's say we do commission this in H2, but in a full year, we could be adding roughly around 2,500 crore to the top line. And maybe EBITDA's in the range of 800 crores plus.
Okay, this is just via the expansion, right? 2,500 crores and 800 crores, right?
Indeed.
Okay.
There are two projects that are on hand.
What kind of TAN prices are you working with, sir? And this is strategically located because it's on the East Coast. Your raw material requirement is, is that sorted?
Yeah. So that we are in touch with the global players, for the raw material. Mm-hmm. And this being on the East Coast, we will be far closer to the customer market, the mines. And to that degree, the Gopalpur project will enjoy also a lot of freight advantages.
Right. No, I just wanted to understand because some part of this will have to be imported, but you don't see that as a risk, right? Your raw material requirement.
Not at all. We have been in touch with various players. And from the Southeast Asia side, from both sides, ammonia availability is not an issue.
Got it. So that clears the point out there. Now, as you're saying, you're going towards that million-odd mark. Give us a few more details. You have a large share in terms of domestic market share. But there are a couple of other players. If I look at Chambal, they have also coming out with their facility. Coal India, well, that facility, I don't know when it comes about, but that as well has been announced. How do you see the competitive intensity in the TAN market? And if you could help us out with what would your market share probably be?
Sure. So what we see is the number one is the end user market is growing. The mining sector is growing through the roof with India's needs for power, India's needs for infrastructure, cement, metals, minerals. So on the demand side, we don't see any issue. There is so far the gap in the demand was being serviced by imports. Now with the availability in India, we are expecting those imports to dwindle because, much better availability will be available from the domestic players itself. Mm. And for us, the advantages that we have, one is we've been in this industry for the last 45 years. Mm. So we know every dimension of it, including every single customer. We have facilities now on the West Coast and on the East Coast. So from that viewpoint, we'll be able to, provide the material in a cost-effective manner to all customers across India, all the mining needs that are there.
Okay.
And we are also moving from pure commodity products to what we call as total cost of operation. So we are going to help the mining productivity.
Mr. Mehta, got it. No, thank you very much. Appreciate you joining us. It's a great quarter, and we wish you all the best of luck to continue the performance. And we'll, of course, track for the 30% business, which is fertilizers, if the government moves, as you've said, a faster transmission of some of the input price hikes to the subsidy which is provided for fertilizer sales. Well, that's Deepak Fertilizer. Mahindra & Mahindra is the company next in focus. They reported an inline performance. Core earnings remain healthy. And the company continues to gain market share, although margins came in slightly below expectations. Lots to talk about. Anish Shah is Group Chief Executive Officer and Managing Director at Mahindra & Mahindra. He's with us here in our studios. Anish, great to have you with us here. Thank you very much for joining us.
Thanks, Prashant. It's a pleasure being here.
Thank you, and I hope you can be here every quarter, but we see you once a couple of quarters.
We have to do something, Prashant, with the expectation management, because last time we were 60% up a quarter year over year, and you said in line with expectations. This time we are 34% up, and it's still in line with expectations. So in a tough quarter at 34%.
I told you once, you keep doing well. I think the expectations are going to keep going higher. So
which is the case.
It's a good problem to have.
It is a good problem.
Anish, margins have been so commodity inflation is, I guess, persisted for much longer than what anyone thought, and I think that's the main. I just want to start with that. It's been, I think, cumulative impact of about 400-500 basis points. It was offset by about price hike of about 4.5%. But just give us a roadmap here. What is because price hikes can offset, but they can't be the solution going forward. What else are you doing to?
So first, to clarify, the price hike of 270 basis point has come in just 10 days ago. So in terms of the quarter itself, while we saw 400 to 500 basis points of inflation, there were a number of other actions taken to reduce the impact of it. So the impact on margin was actually much smaller than that. So margins is not something we're too worried about right now. You're right that price hikes is really not the solution, but it is also a quarter where we've seen unprecedented increases in commodity prices. We've seen rubber go up 52%. We've seen steel go up 24%. And these are not sustainable, not just in India, but globally. And that was driven by the Iran war. As soon as we saw the end of the war at that point in time, towards the end of June, commodity prices crashed. But that was for a very short period of time. Now, that resulted in us having to take a hedge loss, which impacted margins by 85 basis points. So you put all of that together, we're not really worried about margins. It's not a major issue as we see going forward. And we see things getting back to some semblance of normalcy.
From a medium-term perspective, then what? Okay, let me just bring in the other aspect as well, which is EVs, right? And now the mix of electric vehicles is about, 10-12% overall?
It's 12% now.
Yeah.
Yes.
So, but, their margins are, not obviously not comparable to where ICE margins are. So that's the other, in that sense, margin dilutive. And that is picking up, and you're doing well there. So you add the commodity bit in where prices remain high, and you take the EV bit as well. So what should investors expect as far as margins go over from a medium-term perspective?
EV will have lower margins at the start because it's not a scale business. Even at 12%, we are selling almost 9x as much in terms of ICE. So you got the scale, and that scale brings margins. As EV grows, we will get better margins. We are actually EBITDA positive from an EV perspective much faster than we expected. So we are on a stronger track right now. So we have to look at a portfolio of businesses, even within auto. And that portfolio is a very strong one today. There are some that are being built out for the future, like EV. There are others that are doing very well. And despite all the challenges, despite everything that you said about margin, the auto business profit is up 21% year over year for the same quarter. So we're just seeing the business perform at a very high level and building a strong foundation for the future as well. So it's a combination of both.
You've also, Anish, hi, you've also planned to double your SUV capacity in the next 5 years. So as you get that scale and the leverage kicks in, what does it mean structurally for margins? Because even EV is ramping up at the same time, and that is also helping improve your profitability. So over the next 5 years, as you increase your capacity, increase your penetration, how should investors think about the profitability of your auto business?
It will go up, because that's exactly what will happen with scale coming in. We are building a new plant that will be a state-of-the-art plant across the world today. And the new plant will have a capacity of 500,000 vehicles. In addition to that, we are adding more capacity in Chakan, which will give us some more relief in the short run, because today we are operating at capacity completely.
First one is the Nagpur one that you're saying.
The first one is the Nagpur one.
Okay.
So with greater capacity, with greater scale, with EVs ramping up, it will obviously have a positive impact on margins.
Do you want to put a number to it?
At this time,
because
no.
you also no.
But we don't give forward guidance, but we will continue to be on a strong positive track in terms of margins. But at this point, I wouldn't put a number to it.
Because there are a lot of AI initiatives also which are going on simultaneously,
yes,
which would also enhance your revenues and bring in cost savings. So at the auto level, could we possibly look at double-digit revenues for you sustainably?
Our revenue growth has been very strong.
Not
so from that standpoint, yes. In terms of margins as well, we have been at double-digit margins also.
Yeah, you have.
Except for this quarter, we dipped slightly below that. So on balance, I think we've got a business that's performing at a very strong level. It's got demand, which is the most important part. It's operating at full capacity at this point. We're adding more capacity this year, and we are on track to double capacity, hopefully sooner than 5 years out. But I think we'll be able to do that.
So what does it mean in terms of market share, Mr. Shah? Since you're adding capacity, I'll let you go on the margin front, but there could be a targeted market share, right, that you have in mind?
So Nigel, we don't target market share for any of our businesses. But what we do is ensure that there's very strong performance that allows us to gain share.
Okay.
In auto, we have doubled market share over the last 5 years. In SUVs, we are at a 25% revenue market share. We will get into a segment that we haven't played in a whole lot, which is the sub 4 meter segment. We've got some vehicles there. The XUV3XO is a great vehicle, but we still have a very low share in that segment. With the new IQ platform, we have a range of vehicles that are very strong vehicles that will play in that space. And with that, we expect to pick up significant market share. I know you might look for a number there again, but we will not target a specific number. But where I would leave it at is a significant growth in market share.
Okay, we'll let that go as well. But let's talk about, you say that ye dil mange more, right? Every time you deliver numbers, people, some say it's a miss, some say it's better, some say it's in line. But these numbers have been looking very, very good. I think the other stock that's listed, SML, what a move we have seen on that particular number. And now you've announced the consolidation of the trucks as well as the buses division. What's the outlook out there? Because there'll be some procurement, there'll be some synergies that will play out. How much of that is already taken, into consideration from the time you'll have taken over? And what is the trajectory from here on? Because the street seems very, very bullish on that part of the business.
And rightly so. It's a great business. It's performing very well now. To answer your question, a lot of the synergies have not been captured because when you operate as two separate entities, due to related party considerations, you really cannot take all the synergies. Some, yes, but for the majority part, that will happen after the combination now. And with that, we hope to grow even bigger in that space. This is a space where we've got a good business now, but a fairly small market share. And what we are doing is looking at having this business grow much bigger and making it a more significant part of our overall portfolio.
Is there a number in terms of synergies that you're looking at, either in terms of margins? You want to scale that business up to a particular margin, if you could help us out. And you want to quantify, a couple of 100 crores or put a number to it in terms of synergies.
So here, let me give you a number on market share.
Okay.
As we are on numbers. So we started at a 6% market share when we acquired SML.
SML, yes.
As a combination. Our truck and bus business was roughly at around 3 plus minus. SML was roughly at around 3. And today we are at 7.8, 7.9% market share. Our target for this business in the short to medium run is to get to a 12% market share. And then beyond that, we ideally want to get to a 20% market share.
And the time frame?
For 12% is about 5 years. And then to get from there to 20%, I'd like it to be as quickly as possible, but that's something we will see once we get there, because it's a function. See, for us, more important is build the business the right way.
Yes.
And that's what we've been doing with all our businesses. Get the right foundation, have the right people first to start with, the right product set, start thinking about what really the customer wants and over-deliver on that front. So as we do that, the rest of it falls in shape.
I think, the SML stock, since it's been announced, has been on an absolute tear, and I think the market is liking it. Talking about subsidiaries, I have one or two questions on the farm side, but, I just want to put up something for our viewers. So I thought this was an interesting way to characterize the results. This is, Bernstein and their note this morning, and they're starting. I mean, actually, their focus is not so much about autos and the margins here or that segment, but basically, let me read this verbatim. When a company's fastest growing profit pools sit in businesses many don't yet associate it with, it naturally sharpens the re-rating question. For Mahindra & Mahindra, first quarter is the first quarter where many of its subsidiaries move visibly from optionality to contribution in the earnings bridge. Do we still value M&M as a largely domestic automotive plus farm equipment OEM with some embedded options, or as a multi-engine platform where these adjacencies are now central to the earnings power and capital cycle of the group? Question mark. So let me ask.
So first, many compliments to Venu. I think he's captured the essence of what M&M is, because M&M plays today in 70% of India's GDP.
Yeah.
We have multiple engines that are very strong. And over the last few years, we have been building those engines even stronger. And that's exactly what you see today. They're a significant contributor to our earnings growth. And even in absolute terms, Mahindra Finance is up 78% year over year from a profit standpoint. Our growth gems are up 3x. Tech Mahindra is up 28%. And you're seeing these businesses becoming a very meaningful contributor. In the context of that, a 21% growth in auto is fantastic, but it seems lower in that context. So this is a business today which is a multi-engine business, and one that will benefit from synergies across businesses. The power of that synergy is what we are seeing now. We've been talking about some of that as we've been building the businesses. But we are seeing that, the power of talent movement across group, the ability to take very strong talent and put them in smaller businesses where the value creation potential is much higher. The ability to take talent for technology and be able to take that across the group, share best practices, implement best practices, the synergies that we have from stakeholders across, whether it is stakeholders in international companies that we deal with, whether it's media, whether it's government, any stakeholder, there's a tremendous amount of power that the group brings in. The most important aspect is trust. M&M stands for trust. It is our value system that enables that trust, and our businesses benefit from that. And that's what we are seeing drive the performance of these businesses.
Mahindra Finance, Anish, according to you, turned the corner in a sustainable way?
It has, and that's something that we saw 2 quarters ago. And at that point in time, and rightly so, the message was, let's see this sustainably. And we are seeing even some of the harshest critics now talk about it, saying, yes, we've seen it sustainably for some time. We need to continue that sustainable performance. And I do believe it has turned the corner.
You know, you did speak about some of the individual businesses. Shireen got, I think, you got 10 of your CEOs, right? I mean, the entire group and the entire leadership team here. Maybe we'll do another one of those time for, but we can plan that. But you did speak about logistics, real estate. Where are you seeing, this turn coming up the fastest? Because you did speak about, I remember these two businesses specifically. You spoke about others as well. Finance, I think we do. I mean, there's extensive coverage. It's pretty well covered, as you said, and people are acknowledging that maybe that is already happened. The turn has already happened. But the other two, Anish.
Not just both of them, but multiple other businesses also. So real estate, for example, has GDP of 50,000 crores now as compared to 8,000 crores just 3 years ago. And this is our fuel for the future. It's growing at a very rapid pace. I have a number of our competitors coming to us and saying, please don't take more business away from us, dial down the competitive intensity. What have you done with this business? But that's part of what we're doing with multiple businesses. Logistics has had its best quarter ever. I normally don't like saying highest ever quarter because we expect all our businesses to be highest ever every quarter. But in this case, it has delivered very strong operational excellence, which is what the business needed. We've got strong technology, a very strong right to win in the space we play in. And we aim to be the #1 logistics company in India. So we are on track for that. The value creation potential is significant. So that's exactly what I think Venu captured well, which is M&M has moved far from being just an auto and a tractor company. There are multiple engines that are creating value for shareholders. And that is where we are with M&M.
Absolutely. And just to end, let me just finish with tractors, just to close, all the questions in. So tractors had a good quarter, volume growth 17%. How do you expect the rest of the year to pan out? And for the industry, do you still maintain a mid-single digit kind of a growth, or do you think there is a possibility of an upgrade here?
So that, Rima, at this point, we maintain a mid-single digit. I would say with a bias towards an upgrade based on what we've seen in the first quarter. But we'll just wait for a few months. This is one industry that has been very difficult to predict. And every year you see all the experts in the industry, including ourselves, come in and give you a number. And then we are far off by the time the year ends. So what we are seeing right now, at least, is strength in rural India. We see actually an Indian economy that's resilient overall. And that to me is a very good place to be given the challenges we've seen in the world. And rural India in particular. So with monsoon coming in much better than what was expected a couple of months ago, we are optimistic in terms of where this plays out.
Anish, we'll leave it there. Thank you very much for joining us. Great conversation. And again, see you hopefully next quarter again in the studios right here, and not over down the line. Thank you very much.
Expectations.
Thank you.
That's right. That's right. We'll have to work on that part.
All right. Well, we'll just take a quick commercial break. We're up about 27, 30 odd points, 24,344. We'll take that break. See you on the other side. More comes up in just a bit.
There.
(2026) available on the websites of the SEBI, the stock exchanges, the book running lead managers, and the company.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपी अब संभाल लेगा। आप अपना देख लो।
Manipal Health 2026 available on the websites of the SEBI, the stock exchanges, the book running lead managers, and the company.
Welcome back. Nucleus Software is taking a knock today. Stock is down close to about 10-11%. Disappointing set of numbers. Revenues declining on a year-on-year basis for the second consecutive quarter. In Q1, down 3.5%. In the prior quarter, down 1.8%. And as a result of this, margins too have been steadily declining. In fact, margins for Nucleus Software always double digits, but this quarter it's down to 3.6%. Stock has taken a sharp knock. The other one is Data Patterns. Again, disappointing set of numbers. On a quarter-on-quarter basis, also revenues are sharply down 66%, EBITDA is down 84%. But if you look at the EBITDA growth on a year-on-year basis also, it's actually negative. So disappointing set of numbers. Profitability has taken a hit. Just one more stock, Astra Micro on the way up is up nearly 12% on the back of the order win. But otherwise, very, very quiet start. Mid-cap index is up half. We will get into a break on the other side. Lata speaks to CNBC TV 18's Citizen MPC on what to expect from the upcoming RBI policy.
Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपी अब संभाल लेगा। आप अपना देख लो।
Juniper Green Energy Limited,
proposes an initial public offering of its equity shares. The 100% book build issue is being issued at a price band of rupees 214 to rupees 225 per equity share of face value of rupees 10 each. Issue opens on Thursday, July 30th, 2026. Issue closes on Monday, August 3, 2026. For risk involved and other details, please refer to the red herring prospectus, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchange.
23rd, 2026. Available on the websites of the SEBI, the stock exchanges, the book running lead managers, and the company.
Weapon.
Welcome to the Citizens Monetary Policy Committee deliberations. The August policy of the Reserve Bank comes at a time when the crude shocks are not quite over, global uncertainties there, but there is also a massive global capex underway because of artificial intelligence-related investments. So how should the RBI proceed with its policy as inflation starts ticking up? Joining me are the members of the Citizens Monetary Policy Committee of CNBC TV 18. I have with me Samiran Chakrabarti of Citi, Soumyakanti Ghosh of SBI, Sajid Chinoy of JP Morgan, Sonal Verma of Nomura, and the chairman of our committee, Dr. Pranab Sen, the former chief statistician of India and former chairman of the Planning Commission. Gentlemen and Sonal, thank you very much indeed for your time. Well, we have to start with inflation because that clearly is becoming a persistent danger. So to you, Samiran, how do you see the inflation trajectory panning out? After all, we are seeing Asian countries reporting higher PPIs. Our own WPI has shot up. So what's your forecast and what may RBI do to its forecast?
So historically, clearly, there is a correlation between the WPI feeding into the CPI core. But what is interesting is that there is often a comparison done between this episode with what happened during that Ukraine war period. And we saw almost an exact increase of about 7.5% over a 4-month period during Ukraine war in WPI. And then over the next 12 months, that entire increase got corrected downwards. Now, this time around, this is something, whether it happens or not, will be very interesting to see from a CPI perspective, that if it is just a one-time shock in raw material cost and then it dissipates, then maybe the companies will take it more in their margins rather than passing it on to the headline CPI number. So that's something that we have kept in mind while projecting our core inflation also. At this moment, what we are looking at is that the core inflation number moves higher in the latter part of the year, but does not become a very ugly number. Although I must say that other than this particular issue of WPI feeding into core, there is an issue of how to take into account the precious metals part, because without precious metals, the core inflation is much lower. Until the data that we have got, the only pass-through into core inflation has happened in the restaurant and accommodation services component. If you take that off, then core inflation has been very flat in this period. So we are cognizant of that as well.
Okay, I take your point, but the globe is in a different situation compared to what it was during the Ukraine war. So, Sajid, globally, what should the RBI take into consideration while setting the policy? The Fed is perhaps not done with its hikes. We saw Bank of Korea, Bank of Japan, all of them on the hawkish side. So what should the global takeaways be? I think you're on mute.
It's a multitude of shocks. Can you hear me?
Yes.
It's a multitude of shocks in the global economy. It's not just one. Yes, people focus on the Fed because what you're seeing is in developed markets, inflation has been extremely sticky. Whether it's in the euro area, whether it's especially in the US, whether it's in Japan, and so we will expect some kind of synchronized monetary tightening cycle across the world. Now, I think some of these fears are overstated. We got a core PCE number last night from the US, which was quite benign, 0.13. So I think there's no urgency for the Fed to hike in September, but markets still believe there'll be about a couple of hikes over the next year. But for me, it's not just any one shock. There are 4 different global shocks that the central bank will have to be very focused on. One is the tightening by developed market central banks. The second is the fact that the Middle East shock hasn't really dissipated. Crude is back up above 90, and there are still concerns about whether the strait will fully open. Will we have this intermittent closing and opening that's going to keep the energy complex nervous, especially because refined capacities in Russia as well have been damaged. So you've got an oil, simmering oil price shock as well. Number 3, tariffs are back on the table. Section 122 is rolled off, and what we found is President Trump has reached into his pocket and found Section 338 of the Smoot-Hawley Act of the 1930s, which has never been used again, which he believes he can use like AIPA to impose country-specific tariffs. And then we've got El Nino, which is, working through its way through the region and could cast its, longer shadow later in the year. For me, any one shock, Lata, is manageable. If the Fed were to hike by 50, India is well positioned, especially if we get a large gush of capital inflows. If tariffs go up a few percentage points, we can handle that. If oil stays at around 90, we've been able to procure supplies, we can handle that. One bad monsoon, we can handle. The worry for me is the covariance of these shocks. That if all 4 things happen together in the next 6 to 9 months, you get an El Nino, the Fed is hiking, oil is between 90 to 100, and tariff uncertainty is high, and tariffs go up. It's the combination of those shocks. Now, some of these are going to be stagflationary. You will see inflation go up, because of oil and El Nino, and growth go down. And you'll have some pressure on emerging market exchange rates. So this is a hostile global environment, not because there's any one overriding shock, because there's a multitude of shocks that will happen over the next 6 months, which the RBI will have to be very, very carefully watchful about.
Okay. Not for nothing is economics called the dismal science, is it? You put it very nicely. But, I'm going to play devil's advocate, Sajid. There are also many positives. We had this tariff and crude uncertainty for the past 6 months and tariff even for the past 18 months. But Sonal, highest ever credit offtake in the past 2 years. Excellent auto sales numbers. The PMI numbers are strong. Look at the IIP number. That's very strong. Global capex, Asian capex strong. Do you think RBI has to actually upgrade its growth forecast? Your thoughts on growth?
I think not just in India, but across most countries, I think growth has been more resilient than people had feared, both last year with the tariff shock and this year with the Iran shock. So I think particularly for India, managing of the supply side of energy shock, plus the government absorbing some of the cost increase, I think has protected the consumers. And as you put it, most of the high-frequency indicators in the April-June quarter point to an economy that has sustained a very strong momentum, particularly in consumption. So we think Q1 GDP is likely to surprise on the upside. The RBI had projected a 6.6%. Our own forecast is a 7.2%. So things look pretty good. I think the challenge really starts in terms of the two big uncertainties that are ahead and how they impact the growth outlook. Number one is the oil price increase, and second is the El Nino impact on food production and therefore rural consumption going forward. We do think that there will be some tapering of the growth momentum as the year progresses. Cost pressures build up for the manufacturing firms has been quite substantial. That does imply that the value addition will be much lower than what we had seen last year. With July is done, sowing is marginally lower than last year. We do think there'll be some moderation in food production and therefore modest, adverse impact on rural consumption, although the impact of this is more likely to be visible after September, October, so back half of FY27. And we've also seen some moderation in sectors like services exports, which we need to monitor how they play out going forward. So absolutely right, things have been extremely resilient, but I think there are still downside risks that could offset some of the positives we are starting off with. So all told, I think 6.6% that the Reserve Bank has projected for FY27 probably makes sense to hold on to that projection for now until we have more clarity on how these uncertainties actually play out.
No, I take your point on margins. The current corporate earnings season, clearly revenue growth is higher than EBITDA growth. So clearly, the cost pressures are there. Let's see how it impinges on the GDP. But rupee, Soumya, on that, rupee was the talking point in the previous policy. Is it yesterday's story and the Reserve Bank doesn't have to bother about it, or will it impinge? The MPC has to worry about it.
Oh, thank you, Lata. No, I think as secondly put out by the other members, I think even as all the other momentums look good at this point of time on the growth, and also on the external sector, the situation has significantly flipped and when we have discussed last time in terms of an BOP deficit, from a high BOP deficit to a quite decent BOP surplus projections at this point of time. But having said that, I think the rupee movements have actually not in sync with whatever has been the outcome on the external sector. If we actually look into the value of the rupee since April 2025, the rupee actually depreciated close to 12% over the entire period. And during the period April to February, before the war started, the rupee depreciation was, I think, the second highest to Japan. And after the war started also, the rupee has continued to depreciate, and it remains among the top three currencies in depreciation. Only in the last couple of days, including today, there has been a positive moves on the rupee. The point to note over here is that I think as FCNRB flows come in, the projections gets updated, and the point to note is that the entire policy package was to flip the negativity on the external sector in terms of the capital outflows, and that's why the series of steps were announced in the first week of April. My sense is that if you compare this with the 2013 and even the 1998 Asian crisis, the rupee had actually strongly bounced back after the measures were announced. If that is not the case this time, and the rupee, suppose as per the fair value, even the Reserve Bank of own interpretation in terms of an undervaluation a couple of days back as per the governor's interview, I think all these points that if the rupee doesn't significantly make up from the lost ground in the last couple of months or the last couple of years, it would be difficult to sustain the momentum when the FCNRB window is over. And that actually would be a setback in terms of the overall currency.
That's an important point. That's very important, and RBI will be worried about it. I don't know if they'll announce anything or talk up the currency during the press conference. Dr. Sen, if you can, round it all up, how would you assess the India growth inflation mix? Do you think a rate hike is needed now or in the year itself?
Not at all.
Okay.
All right. At the moment, we are in a situation where I think the price effects have already been factored in. However, the quantity effects are yet to come.
Okay.
And I think what we are looking at is a situation where there will be pressure on growth. And we're going to have to manage that. The really important question out here is the timing.
Got that, sir. Well, actually, I have to take a quick break. I intended to take your first vote, but we wouldn't have time. Let me just show you my colleague Ritu, who did a poll with several economists, and it looks like an overwhelming number does not expect change. Actually, 100% are expecting a hold. But what about stance? What will the governor guide? All those questions to the Citizens MPC after the break.
In 2026, available on the websites of the SEBI, the stock exchanges, the book running lead managers, and the company.
Some properties are not just homes. They are statements, achievements, legacies. At India Sotheby's International Realty, we represent the country's most exceptional properties with unmatched expertise. Unique homes, uniquely for you.
Manipal Health Enterprise.